Welcome back to this course, Investment Banking. Today we'll be doing Module 2, which is Global Financial Instrument and Investment Opportunities. This module explains how financial instruments and investment opportunities function within global capital market. It focuses on how money moves from investors to those who need capital and how different instruments and platforms make this possible in a structured financial system. For the module objectives, we're looking at students should be able to understand financial instruments and their importance in capital markets, differentiate between major investment instruments, explain institutional and retail participation, understand liquidity and risk, analyze global investment platforms and opportunities. By way of introduction, in every financial system, money must move from those who have surplus to those who need funds. This process is structured through financial markets and instruments. These systems ensure that capital is allocated efficiently, supporting business growth, government spending, and economic development. Let's look at what investment opportunities are. Global financial markets provide different investment opportunities depending on investors' preference. So, some investors may prefer stability and low risk, while others seek higher returns despite higher risk. Markets therefore offer various instruments to meet these needs. Let's look at types of instruments. Like I said in Module 1, capital instruments include instruments such as shares, bonds, debentures, treasury bills, commercial papers, and mutual funds. Each instrument serves a different purpose and it reflects different risk return profiles. Let's look at assessing financial market. How do you assess financial markets? So basically, investors do not access market directly in most cases. They participate through intermediaries such as banks, brokers, and asset managers. These intermediaries connect investors to financial instruments and shape how capital flows in the economy. Let's look at the meaning of risk and liquidity. Risk is the probability that something will happen, while liquidity is the extent of how you can solve your short-term obligations. Now, investment decisions depends on balancing returns, money earned on investment, risk, this probability that an event will occur, and liquidity, ability to settle short-term financial obligations. An investment may offer high returns but lack liquidity, or be highly. When it means liquidity, it means that you cannot easily get your money, or be highly liquid but volatile. But I think this has to do with how fast you can get your returns. Investors must evaluate these trade-offs carefully. So if you cannot get all three at once, you lose one and you get one, or you lose two and get one, or you lose one and get two. Let's look at global investing. Modern investing is global. You can stay in your house and invest from anywhere. Investors can access markets across countries through technological and financial platforms. This allows diversification but introduces risk, such as currency fluctuations, just like the dollar and naira, and regulatory differences. Now, financial instruments define how capital is raised and invested. They determine ownership, repayment conditions, expected returns, and risk level. So, the type of instrument you trade in will determine the kind of ownership you have, the kind of repayment condition that will be attached, the expected returns to that investment, and the risk to that investment. They are essential for capital formation and economic development. We have looked at mutual fund before, where we said mutual fund pull money from many investors and invest in diversified portfolios. They provide professional management and global diversification, making them suitable for investors with limited expertise. So a mutual fund is like an organization that organize different funds from various investors, and put them into diversified portfolios. Let's look at bonds. Bonds represent loans to governments or corporations. Investors receive periodic interest and principal, that is money invested, repayments at maturity. They are relatively stable but still subject to risk such as credit and interest rate changes. What about debentures? Debentures are unsecured debt instruments. Investors rely on issuers' financial strength rather than the collateral, but debentures are higher, or they offer higher risk, do offer returns due to higher risk. What about shares? Like I said before, shares represent ownership in a company. If you buy shares in, let's say, A Limited, you have ownership in that company. Investors benefit from dividends. Dividend is the um, money paid yearly from profits, and price increase, that is, price per share may increase, but face higher risk due to market fluctuations. Treasury bills, like I said before, are short-term government securities issued at a discount. They are considered safe and used for liquidity management. What about commercial papers? Commercial papers are short-term corporate debt instruments. They provide flexible financing for corporates, for companies, and higher and offer higher returns than government securities. Importance of instruments. Different instruments serve different needs. Some provide stability, others growth. Together, they create a flexible financial system that support both investors and issuers. Let's look at institutional investment. Institutional investors, such as pension funds and insurance companies, manage large pools of capitals. Their decisions influence market prices, the liquidity, and overall stability. Let's look at retail investment. People that carry out retail investment are called retail investors. And what do? They use personal funds, their own money, and access market through platforms and intermediaries. Technology has increased the participation of retail investors, but challenges such as limited knowledge and emotional decisions remain. Let's look at role of intermediaries. Who are intermediaries? Intermediaries is the link between people that buy from investment bank and investment bank themselves. So we have banks, we have brokers, and we have asset managers. They provide access, execute trades, and manage investment, making participation in investment banking possible. Let's look at market liquidity. I already explained before. I said, like I said earlier, liquidity refers to how easily an asset can be bought and sold. Highly liquid markets allow quick transactions with minimal price changes, increasing investor confidence. So the higher liquidity you have, the better. The higher liquidity an investment has, the better for you as the investor. Let's look at volatility. And what is volatility? Volatility measures price fluctuations. Volatility means higher risk. So higher volatility means that prices change very quickly. So higher risk. Investors must consider credit risk, interest rate risk, and liquidity risk when making decisions. What is diversification? Diversification reduces risk by spreading investment across assets, sectors, and regions. So diversification means when you take a certain amount of money and you don't invest in one security alone, you invest in many securities. That process is known as diversification. It ensures that poor performance in one area is balanced by better performance elsewhere. What is portfolio allocation? Portfolio allocation determines how capital is distributed across investments. It balances growth, stability, liquidity based on investors' goals and risk tolerance. Let's look at global exchanges. Exchanges provide structured platform for trading securities. They support price discovery, liquidity, and investor confidence in financial markets. Let's look at the Nigerian market. The Nigerian market is known as the Nigeria Exchange Group, which supports equity trading, while the FMDQ support debt and money market. So this FMDQ is a part of the Nigeria Exchange Group that supports debt and money market. Together, they form the Nigeria capital market system. Let's look at some of the major global exchanges we have around the world. We have New York Stock Exchange, we have NASDAQ, we have LSQ, we have Euronext, we have Johannesburg Exchange, and others. These platforms connect investors worldwide and provide international capital flows. Now, by way of conclusion, this module explains financial instruments, investment channels, liquidity, risk, and global exchanges. Understanding this concept is essential for making informed investment decisions in the global market. At the end of this module, there is a 15 SAQ question accompanied by a report to follow up your understanding on this module. I'll see you in module 3.